buy down. What is a mortgage buy down? A buy down is when you take money, you as a borrower looking to get a mortgage, get money somewhere, somehow to put it towards your mortgage. You're getting money to get a lower interest rate. So where does this money come from? This money could come from anywhere, really, in the grand scheme of things. So you're getting a chunk of money, and you're paying the lender to lower your interest rate. It's a way to get a lower interest rate. So the money could come from sellers, lenders, real estate agents. It could come from equity in your house. It could come from a builder if you're building a house, or you could actually just pay it, write a check out of your own, money. So buy downs can come from anywhere. Essentially, it's just a chunk of money that's buying down your interest rate. So an example of this is if the going market rates are 6.75%, and you're buying a house and you want to get a lower interest rate, you could get a chunk of money to get your rate theoretically to say 5%, and this will benefit you, lower payment, and that's maybe of interest to you. So you could do a what's either called a temporary buy down, which is that money goes to help lower your rate and payment for the first 1, 2, or 3 years of your loan, and then it gradually goes back to the regular rate. So in this example, if you could do its current market rates are 6.75%, you could get a chunk of money, pay it into this loan, and your rate could be 5% to the lender. So there's two types. The temporary is good for, if you think rates are maybe going to go down eventually in the next 1, 2, or 3 years, you could take this type of loan, and then in that time frame, you would refinance your loan. And if you think market rates in 2 or 3 years from now will be 5%, at that time you could refinance and fix in a rate of 5% theoretically. If you think rates are going to go up, then you might want to do a permanent buy down, which is it's a similar thing. It's just instead of temporary over the first few years of the loan to get a temporarily lower interest rate, you would use that chunk of money to put towards your loan to lower the interest rate over the course of the entire 30 years. So you pay it off, and say it's on that type of loan, it might be 5.9%. So instead of a 6.75 theoretically right now, so you wanted to do a permanent buy down and the interest rate market rates are 6.75, you could pay down a chunk of money to get a rate of say 6% for 30 years. It never changes. That's it. Costs you money up front. So on these examples, a temporary buy down right now could be about So temporary buy down right now would be on going from a 6.75, say that you wanted to do a 3-year buy down, it would cost you somewhere, you get funds somewhere somehow of $9,739. That would buy your rate down the first year to 4.75%, second year 5.75%, and then the third year and thereafter is 6.75%. So it is $9,739 on a $400,000 loan amount, approximately $500,000 purchase price. So that's what that is. If you wanted to do a permanent buy down, so permanent buy downs are more expensive. So say market rates are 6.75, you pay $13,000 to get your rate down to say 6%. For the entire course of your loan. So it's a little more expensive, and you don't get as low as say the lower rate on the first year and second year compared to the full 30-year discount over the course of 30 years. So the reasons you would want to do the temporary buy down is because you think rates are going to come down in 2-3 years. If you think rates are going to stay the same or so, and you just want to, do get a lower rate from say 6 instead of 6.75, about 5.99 or something like that, then you could do just a simple. It's the same. It's also called a discount point. You're just buying the interest rate down with a chunk of money up front. So in the example of a lender giving you the money, sometimes there's current deals right now where a lender would actually pay that money towards you. There's certain loan programs that they'll do it. You don't have to pay that money back, but there's limitations on loan amount, how much they'll give you, etc. That's ideally, that's great. That's the best. This money could also come from a real estate agent. They could come from a seller of the home, which is the big way to negotiate this in when you're trying to buy your house. You negotiate that amount of money to be bought down in your rate. It's just a dollar amount, and you negotiate that into the purchase of your home. So it could also come from a builder, and that's most common. A builder will pay a chunk of money. They'll take it out of the price, give it to you to pay your rate down. That's very common because they take it off the price because they're the seller and the builder, so they have an ability to kind of negotiate that in. You can also just, write a check, basically. So if it's an extra 7, 8, 9, 10, 13K, if you have it, you can just write that check. You can pay that down out of yourself. That's great. And the last way is, it's almost like a refinance. It just kind of comes out of the equity of your house. So if you want to buy that down, comes out of the equity of your home if you're doing a refinance. So the difference is up to the desires that you have for where you think interest rates will be, and also how long will you be in your home. There's a lot of theoretical numbers that you could run. Right now, as of end of December 24, rates are kind of highish, mid to high sixes. So if a lot of people kind of feel that the temporary buy down might be a good option to see, because a regular buy down is only going to get you a little bit less, down to say 6%. So if you think that 6% for 30 years, if you're going to be in it, your mortgage and your house for 30 years, then you could decide that. If you think that in 2 years it might be possible rates are like at 5%, then you're better off doing a temporary buy down.